Good afternoon, everyone, and Happy New Year to you all. Thanks very much for attending today's webinar. We're looking at around about 45 minutes to an hour for today's webinar. It's going to be a topical update on capital allowance claims, the legislation that came in a couple of years back. I'm delighted to be joined by Andrew Stanley, Managing Director of STax, who are professional partnership with PFP in working on capital allowances, and Andrew's going to take you through the webinar today. Please feel free to ask questions as we go along, the more the better, and we'll also look at answering as many questions as we can at the end of the webinar. So Andrew, good afternoon, thanks very much for coming.
Thank you very much, Chris, and Happy New Year to everybody there. Thanks for logging on at this early January date. I know everybody's probably a little bit busy out there in general practice. We're going to be taking a bit of a general overview of capital allowances on fixtures, the new legislation that we saw come in 2012 and 14, and how this affects any of your clients who are owning, buying or selling commercial buildings or a limited number of residential properties. So we're going to break the presentation down into three key areas. We're going to have a bit of a look at the background, just to fill in any sort of blanks in knowledge and make certain we're all on a firm foundation. So we call this the what, how and why of capital allowances. We're then going to delve into the main meat of the webinar, which is the new legislation, or we say new. 2012, of course, is now 6 years ago. So the legislation's older than my daughter, and it certainly feels like she's been around for a little while so far. So we're going to look at some of the details, the dangers this legislation throws up, and of course, obviously, the opportunities for effective tax planning for your clients. As we'll see, the legislation that came in FA12 has some very sharp teeth in it for non-compliance. It brings in a hard 2-year time limit in which to get your ducks in a row. If you don't get your ducks in a row, then potentially your clients can stand to have quite substantial financial losses. And of course, in those sorts of situations, certain element of taxpayers out there will be wondering whose fault it was, who didn't advise me, and whose duty of care is it to protecting me from this non-compliance. So we're going to have a bit of a look at that and look at some practical tips as to what you can do in your practice to make certain that you're putting forward best advice, but at the same time, obviously protecting your firm. So capital allowances in general, well, given that I should imagine everybody out there is as an accountant of one flavour or another, I'm going to zoom through this section very quickly. In essence, tax allowed form of depreciation on certain items of plant and machinery. You spend money on qualifying items, their value is added into your capital allowance pool, and you get a relief for a writing down allowance, either 18 or 8% each year on a reducing balance basis. Annual investment allowance, just going to touch on this because it's historically very high. Currently at the moment sitting at £200,000. Of course it was £500,000 before that, £250,000 before that, and over the last few years it's been 50, 25 and 100,000. So there's nothing like consistency in tax legislation to allow businesses to plan, and that's absolutely nothing like it. At the moment, for current year expenditure, it means that for most businesses you can write off all of your capital allowance eligible spend up to 200k. So it makes new qualifying expenditure even more attractive because you can bring it through the tax benefit very quickly. So what can we claim capital allowances on? Well, in broad brush terms, you are allowed to claim capital allowances on expenditure on plant and machinery. Now, historically, the identification of machinery has not posed too much of a problem. Okay. However, what is or isn't plant is a very different animal. Now, if I was giving a live presentation, I'll ask the audience here, does anybody know the statutory definition of plant? It's a bit of a trick question because there isn't one. Hence the reason why we have to contend with 120 years worth of case law. The closest we have is that an item of plant is not your stock in trade or the fabric of a building which you trade from. So negatively defined is not being those two items, which of course leaves a potentially infinite number of items that it could be, hence the long list of case law and attempts to kind of define this animal. So what are we interested in, and what does the new legislation from FA12 have a bearing on? Well, it only relates to fixtures. Okay, so I'm not going to sit here today pretend there's any sort of mystery to wider capital allowances. Of course, loose items, chattels, whatever plant and machinery your clients are using in their businesses, probably even an element of renovation spend, I'm sure you're adding into the pool and claiming the relevant relief on. So these would be loose items of plant, such as the transit van. Therefore, it's not a fixture. A fixture is an item that's actually fixed into the fabric of a building. So nailed, screwed, glued, however it's actually attached. But it's all the items that if you pick the building up, shake it up and down, that don't fall out. So you can see there, well, probably can if you've got quite a large screen, the Fire System 4000, a particularly swanky fire alarm in a building that we surveyed many, many years ago now. That is attached to the building and therefore is a fixture. And therefore, the FA12 changes have an effect on it. They don't affect the loose plant. So what else is fixtures? Well, Sanitaryware is widely accepted as being a fixture. The grab rails you can see there, the hand dryer, the items like the mirror on the wall can sometimes be eligible for capital allowances. The tiles on the floor are not held to be capital allowance eligible, even though a lot of other floor coverings are. Case law says that they're too affixed to the building and therefore become part of the structure. Similarly with the wall, you have to be careful because only tiles providing a splashback function are eligible for capital allowances, not a complete wall covering. But of course, in this scenario, in a public toilet setting, who's to say where the splash zone is or isn't? I mean, it could depend on people's aim, can't it? But these are the sorts of things that have been debated through the case law over the years, and why it's quite a dangerous area to put your, to stick your neck out and say, yes, this definitely is, or this definitely isn't eligible for capital allowances. So, integral features. I'm sure some of you heard of integral features. All integral features are, in essence, is the handle for special rate pool fixtures. Okay, so these are items that you get a lower rate of relief at, 8% rather than 18% in the main pool. And they tend to be things like the utility infrastructure, lifts, air conditioning. What HMRC sees as being assets that have as much as a 25-year shelf life. These came about in 2008, which is a key date to remember, because this will have an impact on when the new legislation is or isn't in effect. That was now written into Section 33A and 33B in the Capital Allowances Act. So, as I mentioned, air conditioning is an integral feature. In this picture here, you can see a chandelier within a circulation area of a hotel in the hallway, which in this setting, within the leisure industry, potentially qualifies for capital allowances. If this was a shoe factory, okay, it's very difficult to argue that you have a business use for this this chandelier. A strip light or a bulb hanging from the ceiling would have been sufficient. Even if you are, the Cinderella shoe company, you probably find that revenue will push back on a claim for an expensive chandelier. But in this setting, the chandelier's function is business critical because it creates the ambience, which justifies the room rate and makes people come back again and again to stay in your hotel. So I suppose the bottom line is what is or isn't eligible for capital allowances can change on the industry type, the building itself, the micro location of the asset, just to mention a few parameters that have to be considered. So we just kind of finish this section off before we move on. Here you can see a loading bay in an industrial unit that we surveyed many, many years ago. So green arrows are indicating items of plant and machinery, but they are not fixtures. And therefore, the new legislation from FA12 does not have a bearing on. You can certainly add the value of the forklift and the desk into the capital allowance pool and so on, not a problem at all. But what we're concerned with today are the items that are attached to the building. So you've got the vinyl curtain there. You've got the electrics on the wall. You've got the motor and the runners on the electric shutters. You've got signage on the wall. And you've also got a huge number of items that you cannot see in this picture because they will be in the fabric of the wall, within the roof, or under the ground. And because of this, you tend to see a scenario like this in most businesses where only the tip of the iceberg is being claimed and the majority remain hidden from view. Now, I will stress this is no negative reflection on firms in general practice. The tax system is vast, okay? And no one of us or any firm could be a master of all of it. It is also the case that a lot of these items will be in place when you purchase a building, and therefore your qualifying expenditure, which is the purchase price, is completely disjoint from the sum of the component elements that make up that building, because many other factors will drive it, such as the land value, redevelopment potential, the rental yield that can be achieved, even your own personal negotiation skills when it came to the to hammering out the deal to purchase. Because of this, we need to go through a process called an apportionment to calculate what ratio of the actual building is eligible for capital allowances, to then multiply through by the actual qualifying expenditure incurred. And that's as much a surveying and valuation question as it is tax. So how does this work? Well, imagine this pie chart represents the full reinstatement cost of a building, okay? My quantity surveyors would go there, we would value everything. We have an itemized rebuild schedule, what we'll call an elemental bill, breaking down to as much detail as a number and type of door handles, meters of cable, depth of foundation, slates on the roof, and so on. It's a huge spreadsheet, many thousands of lines. From this, my tax team would analyze the data, and we would isolate all the items that we believe to be eligible for capital allowances. So imagine that's 25% of the total. We're then left, by default, with all the items that are not eligible for capital allowances, generally the raw structure, so the roof, the walls, the floors, the doors, and so on. And we'll also value the land as a cleared site with planning permission to rebuild that same building, generally using a residual valuation model, effectively a rental appraisal as to what a commercial developer who's looking to build to let would pay for that land to build the same building on. We can now take the part of this ratio that relates to the eligible plant and machinery and multiply through by the amount of qualifying expenditure. So if you bought the building all in for £1 million, including stamp duty and so on, in this instance, you'd now be adding £250,000 of capital allowances to the pool. I've made it a single pool example just for ease of the understanding. What we do in reality works on an item by item basis. So there's numerous calculations all running alongside each other that wouldn't work very well in a webinar. So what does this mean? Well, £250,000 worth of capital allowances is, in corporation tax, in old corporation tax at 20%, it's £50,000. For additional rate income taxpayer, it's £112,500. So that's over 11% back in cash on what is not a huge commercial building to buy. Certainly not here in London, where we're sitting. £1 million doesn't get you a lot in this day and age. It's a hell of a large amount of tax savings to not tap into if they're available. So, what buildings are eligible for this relief? Well, in fact, actually, the way it works is that all buildings are able to claim capital allowances, but then dwelling space is actually excluded. So what this means in reality is that all types of commercial uses, furnish holiday lets, all the floor space can be looked at. If you've got a larger multi-unit residential buildings, we're not talking a 3-bedroom student house, we're talking a block of flats with 20 apartments, then the true communal space, hallways, lift, reception, gym in the basement, plant and machinery in the car park, these can also be looked at. Should just mention as well, actually, from a timing and viability perspective, there is no statutory time limit, barring what's set by the FA12 changes, or how far back in time you can look to claim against your expenditure. So if you bought a building 10 years ago, you can still claim those pool additions in the more recent returns. You can't reopen that return from 10 years ago, but you can claim the benefit of that expenditure in the more recent periods. However, your claim is always driven by what you spent, not what something's worth, which of course, if you look too far back in time, can be two very different figures. And inflation can make the process a moot point. Generally, we're looking back over the last 15 years. So why should your clients claim? Well, a whole load of bullet points are going to pop up here on the screen. I'm not going to read them out. Every presentation needs a horrific bullet point slide, and there's a few in this one, so apologies. But the bottom line is that the answer is money to them. They're either investors or their businesses of one form or another. And the reason why they're doing that is to see a return. Tax for a successful business is one of the largest costs, and therefore if you can reduce it on money that you've already spent, yeah, in a non-controversial way, in many ways, it'd be a bit balmy not to. So that's why, obviously, your clients should look at this. However, what are the benefits to your practice? Now, I'm out and about seeing firms in general practice pretty much all the time. And there's a bit of a split in the marketplace, I'm sure you guys have seen, where a lot of the value has been taken out of your raw compliance work by people like Xero, Cashflow, or the more kind of factory set up accountancy firms that are firing out so many thousand contractor accounts a day. And the firms in that part of the market are locked in a race to the bottom for fees, whereas the other half of the market seems to be heading more towards a value add model, where they're bringing in as many additional services, from everything from timely management accounts to capital outs or R&D claims, as and where relevant, to be more of a general business advisory role, and stay out of that race to the bottom for fees. So, a couple of things. By bringing in the right specialists at the right time, you're certainly going to look to build goodwill of your clients. I mean, if you turn around and you make a tax saving for them, they're not going to be unhappy. Often we see this gives a competitive edge over other firms that aren't doing it. Certainly, if they've got a weighting in a sector where they have a lot of real estate investors or developers, and if they're not looking at this, then we have seen some firms who've used capital out services or R&D claims and so on to go out and actually poach clients. Now, that's a bit more aggressive than most general practice firms, but it certainly puts you in a better position than if you're not bringing forward these sorts of relevant areas of advice. We do pay a small referral fee because there is an amount of work that our partners in general practice have to do, amount of information we need, amount of speaking to clients and so on. So it's only fair that that time is remunerated. Certainly this time of year, as time is at a premium for everybody. And you're also avoiding the complete opposite of the top section of this slide. If you're not bringing forwards timely advice in this area, then with the new legislation, especially when people are buying or selling, they can stand to lose all entitlement to future relief and even clawback of past relief. And of course, it's not going to win you any friends. It could even lead, in some extreme cases, to potential negligence claims. So best to be avoided.
Questions just come through, Andrew. It's probably relevant to that point there about not putting the claim through or not advising the clients. Is it possible to put a claim through post-sale? So a sale of a building's gone through for one of the firm's clients here. They're asking, is there something you can do after the sale's gone through?
There is. There's a 2-year compliance window for the FA12 changes, and we'll look at this in a bit more depth in a minute. It's generally better if it's addressed before the sale goes through, because then all parties are motivated for the sale to go over the line, and it can be part of the wider transaction negotiations. Does take two to tango now. So if you're addressing it after the sale's gone through, then you will need in most instances, the assistance of the previous owner or the new owner, depending on if your client is buying or selling. And unless they're the nicest people in the world, they're going to need some form of motivation to assist. Generally, some form of arrangement to be reached on division of allowance or even a cash flow allowances deal. But it's better to end up with a small slice of the cake rather than a big slice of nothing.
Thanks, Andrew.
Okay. And the last point here as well, because these changes, awareness in this area is a lot higher. It's great news for our sector because people who are in the know are looking for advice. Of course, in the future, I mean that everybody either will have claimed or never can claim, and therefore we may have to, expand our offering. But chances are, if you've got clients who are involved in these sorts of buildings, they're going to hear about this sooner or later. And it'd be better if they heard about it from their trusted advisor, rather than somebody down the pub, for example. So, moving on to the main meat of the matter. The new legislation kicked in 2012, but part of it was actually staggered 2 years to only be effective from April 2014. Both those dates are a long time in the past now, so for any transactions going through, both parts of the legislation are in effect. So it's only when a building is bought or sold that it has a bearing. So let's have a look at what's supposed to happen when a building changes hands, and then we can look at what's changed now post FA12. So if you remember our Cinderella shoe company from earlier on, let's say that Mr. Cinderella bought his industrial unit for £1 million 10 years ago. He spoke to us 5 years ago. we conducted a review of the building, and he added £250,000 as capital allowance. But I would just say that would be very high for an industrial unit, but just for ease of maths in the example. Over the years, he's used his rising down allowances, and he has 100k left in the capital allowance pool today. So just imagine a single pool system again, just for ease of example. So building comes up for sale, sale price is negotiated, whatever value. There's no direct correlation between capital gains or chargeable gains and claiming on fixtures unless you sell at a loss. So claiming one doesn't increase the other. So what's supposed to happen is that the parties have a commercial discussion and an effective transfer value is fixed by a joint election called a Section 198 election, which I'm sure some of you have had sent you by conveyancing solicitors and so on to review and complete. The value on this election can be anywhere from £1 per capital allowance pool, so in this example, a minimum of 1, right up to the total amount that's ever been pulled on fixtures that are still in the building. So in this instance, the whole 250,000. So let's have a look at what impact those values have to illustrate what the election does. Okay, it's a straight seesaw between the two parties. So it fixes the disposal value for the vendor and the addition value for the purchaser. So forgive us if you can hear the wolves closing in the background. It's a bit of a windy day here in the city, so apologies about that. But if the election was set at £250,000, then you would have plus £250,000 to the purchaser's capital allowance pool and minus £250,000 from the vendor's pool. So keeping the maths nice and simple for this point in the year, minus 250 from 100 would drive us into a negative 150 and therefore create a balancing charge to the P&L. So there'll be a tax charge on effectively notional profit. So not great news for the vendor unless they had some large carried forward losses or some other way of absorbing this. It was set at £100,000. That'd be the tax written down value. That would take all of the available capital allowances from the vendor, give them to the purchaser. Some people would say this is a fair value. I don't think the word fair really comes into this. This is a commercial negotiation, so it all depends on who's in the driving seat. Often you'll see a de minimis value of £1. This would be not great news for the purchaser. They would only have £1 available to go into their capital allowance pool, but the vendor would only bring minus £1 against the pool balance of 100,000. So they were left with £99,999 in the capital allowance pool, which to some people may seem, often we're asked, well, how does HMRC accept this? Because they don't even own the fixtures anymore. They've sold the building. Well, it doesn't actually make any difference from HMRC's perspective, because you're just simply talking about jam here to jam there. It's still the same amount of relief in the system. Well, the problem came in before 2012 was that the most common election you saw was one that didn't exist at all, mainly because the conveyancing profession was generally not putting forward any form of advice in this area. And because of that, George Osborne, you remember him, he felt, it seems a long time ago now, he felt that people were double claiming relief. I would own the building, I would claim £1,000 on the boiler, I would sell it to Chris, he would claim £1,000 on the same boiler. Sometimes maybe £1,500 because the price may have gone up. And there's only supposed to be one set of relief in the system, and the elections are supposed to move any sort of residual value down the chain until that item is replaced or upgraded. And it was felt that that wasn't happening. The more cynically minded will say that, well, the new legislation means that after 2 years, if both parties don't know about this, that building drops out the system for good. And therefore, part of the latent claim, and there was a report done in 2011 by Deloitte showing that £82 billion was unclaimed out there. I think that might have caused Mr. Osborne to fall off his chair. But the new legislation will mean that as the building stock rolls round, a large proportion of it will drop out the system for good, and therefore that latent claim will be eroded. So let's have a bit of a look under the hood, see what the mechanics of this are. So let me just get all the bullet points up here on the screen. So, two main requirements. The disposal value statement you can see there on the C is as an alternative to the fixed value requirement, and very rarely comes up. It's only when the vendor is outside the charge to tax due to change in circumstances and several other instances. We won't go into that because that will just overcomplicate the situation. 99% of cases we'll be worrying about the pooling requirement and the fixed value requirement. So what do these mean? Well, the pooling requirement states that the vendor must pool the value of all fixtures that it's legally entitled to in a period up to and before sale. Anything that isn't claimed by the vendor can never be claimed by anybody else further down the chain. So the next owner, or so on. So if you've got someone selling a building who doesn't know about capital allowances, unlike whereas in the past, you could have done some homework, checked for their history, and potentially made a claim as a percentage of your purchase price, you can't do that anymore. You need the vendor to pull the value and then transfer it to you in reference to what they spent, not what you're spending. It is worth mentioning this has a bearing on items that the vendor is legally entitled to claim, and we'll come back to that in a moment. The fixed value requirement then states that on every pound that's been pulled by the vendor, a transfer value of some form must be fixed by one of two mediums only, either the joint election, section 198 we saw just a few minutes ago, or by determination in the tribunal. Okay, no other figures anywhere in a contract or other forms of agreement will be recognized in the eyes of the Capital Allowances Act. Okay, if that value isn't fixed at some level, then in essence, both parties get the worst possible outcome. Okay, the purchaser will get a nil value, which will be binding on all those items. So effectively, they will lose the right to ever claim on anything in that building that was in there when they purchased it. And the vendor will still have to bring in a market value disposal in line with the table under section 196, which in a rising market is going to be everything they've ever claimed, which is going to result in that balancing charge we saw a few minutes ago, and probably a very unhappy building, former building owner. So,
a couple of questions I come through. Actually, one from Brian. Thanks for your question, Brian. He's just actually mentioned the quantum of capital allowance is not agreed prior to completion. Is it a case that it's lost forever? I think you just covered that one off there.
Yeah, these requirements have a 2-year compliance window. The 2-year anniversary of completion, then you have to get the section 198 election to HMRC or have started the tribunal process. 2 years and 1 day, you can probably guess how sympathetic HMRC are when you send that election in late. So if it's a recent sale that's gone through, there potentially can be a win-win path that can be tread between the parties, because the vendor needs to close off their history, or they may never have claimed anything. But the purchaser can't tap into the value without the vendor claiming it and transferring it. So quite often we're negotiating scenarios where we're working for the new owner and approaching the previous owner and saying, well, look, you can pull this relief, transfer 80%, 70%, sometimes 50% to our client, retain the residual, and therefore everybody ends up with an element of the value, rather than walking away with absolutely nothing at all. After 2 years, it's still worth having a quick look at, because there may be items that the vendor was unable to claim, and we'll touch on this again in a moment, which therefore means that the pooling requirement didn't have a bearing on it. For example, there may have been a government body, a charity, or pension fund, something along these lines, non-taxed entity. So there may still be something that can be done then, but it might be 5 or 10% of cases might be that lucky. So it's always worth having a look at. As a firm, we only have a charge as a percentage of what we deliver at the end. So to give a quick desktop review of a scenario and let you know what can or can't be done, takes us 20 minutes or so, and could obviously save your client quite a substantial amount.
Well worth looking into that.
Yeah.
I've just got one quick other question here. It's a fairly simple one. We get asked this quite a lot. Is it possible to claim on leasehold, or does it have to be a freehold property?
Depends on the leasehold. There's 2 different scenarios as well. There's different rules if you're buying a second-hand lease, or whether it's the grant of a new lease. The grant of a new lease, you need a Section 183 election in place as well. However, got to bear in mind, we're working with capital expenditure here. So if you've got a 999-year lease, all of the lease premium is capital expenditure. So in some ways, that's a pseudo freehold and is treated in a similar way. We have to worry about any sort of superior interest, such as the freehold or head leases, and also of course subleases as well. If it's a shorter lease, for every year down from 50, 2% of the premium becomes revenue in nature rather than capital. Okay. So if you've got a 40-year lease, we can probably look at it. If it's a 5 or 10-year lease, we can look at renovation expenditure. Yes, certainly, but probably not the lease premium, because to be blunt, there probably wouldn't be any on a lease like that. It's more of a rental arrangement. So the answer is yes in some instances, but again, we have to have a chat about it on a case by case basis.
Thanks, Andrew.
So just moving on, just to illustrate the impact of not complying with the legislation, we have our table from before. So let's say that we're back to the same example. So Mr. Cinderella, he's pulled 250,000, but his conveyancer, no one else has mentioned this to him itself. He's sold the building with no election in place and with no decision of the tribunal. Okay, what's going to happen? Well, he's going to get a market value disposal enforced by HMRC. If of course they connect up the dots, they're collecting a lot of data this day and age, but they're not. From our experience, they're not the quickest at getting there, but they generally get there in the end. And we always work on the basis, of course, that everything will be looked at in tax. So what should happen without the election is a £250,000 disposal value brought against the pool, which would drive them into that negative 150. The purchaser doesn't even get a pound. Okay, they get nil binding on everything, which is in itself a disaster, but also that's binding on future owners. So they've just devalued that building from day one. What does this mean in monetary terms? Well, minus 250 from a pool of 100k equals minus 150. So 30k in old corporation tax to the vendor, or 67,500 pounds in income tax, plus also the loss of 100k's worth of capital allowances. Purchaser gets absolutely diddly squat. HMRC takes £250,000 worth of relief out of the system, potentially netting 30k's worth of corporation tax at the same time. As you can see, Mr. Osborne was looking a lot happier. When I was out doing seminars in 2016, I mentioned that he's probably not looking so happy now, but I think hearing about his recent exploits, he's probably back to having that big smug grin on his face again. The Treasury's estimates at the time were that there would be a net benefit of £35 million a year to the Exchequer. Personally, I think that figure is very low. There are no hard and fast statistics out there. It will generally be a lot of buildings at the smaller end of the scale that are going through with conveyancers who do 90% residential, 10% commercial, and there'll be no recourse to this at all. All those buildings will be dropping out the system now, never to be able to tap into this relief ever again. So a couple of notes to when this legislation is and isn't in effect, and we've touched on this a few times as we've gone through. Mandatory pooling only has a bearing on fixtures that the vendor can actually pull. Okay, so if they're holding the building as trading stock, such as a property developer, they're not eligible to claim any capital allowances on fixtures, and therefore mandatory pooling has no bearing on the on the building at that point. Similarly, if they're a charity that's got fully exempt status, a pension fund, government body, then also it can be very good news if your client's buying the building, because it can be, subject to checking the history, a much easier to open door from capital allowances perspective than if you're buying from a commercial entity. Also, if you recall, the integral features legislation kicked in 2008. So when that legislation came in, it was deemed to be tax neutral. It was tax neutral because it took several main pool items, such as the air conditioning, lift, heating, and so on, and they dragged this down into the special rate pool. So it went from at the time 20 to 10, or so, but at this point 18 to 8%. At the same time, several classifications of fixtures that were previously ineligible became eligible. And these are the general electrical systems in the building, lighting, cold water, in some instances retrofitted thermal insulation. So there was some items that before that point you couldn't tap into the value, suddenly became items that you could. So if the person you're buying the building from bought the building before April 2008 and hasn't spent any money on it since, then they would never be able to claim those items, which means that your client or you could claim as a percentage of the purchase price on those items. So probably about 4 or 5%. So not a huge amount, but if it's a large enough transaction, still certainly worth going through the process of checking the history, surveying the building, and putting the claim through. So we would say never, because it's not until we actually break earth and get stuck in that we know exactly what can and can't be achieved with the building that's changing hands. Generally, it's better if we're involved before the building exchanges contracts, because then we can speak with the conveyancers, we can speak with the with the actual client themselves, and we can suggest certain courses of action that generally allow them to secure a much better outcome without sacrificing anything than they'll be able to do so after the deal's gone through.
Got a quick question here, Andrew, from Simon Hopwood. It ties in with what you've just been talking about. Simon's asking, where a client's identified a property which they're looking to acquire? Simon's initial question is, what questions should he as an accountant be initially asking to identify whether there's a potential claim there for capital allowances? And then presumably the date the vendor acquired the building is paramount to whether it was acquired pre or post 2008. And also, should they look to identify the tax status of the vendor as well? So whether it's a charity or pension fund as well, because that would affect the type of claim that you can put in, can't it?
They're all very sensible things to check. I mean, in an ideal world, you're going to get nice detailed answers in the CPSEs, which are the Commercial Property Standard Inquiries. In the reality, you tend to get at best NA or smiley faces. I mean, my favourite is the first question where it says is the building held as stock or investment? And sometimes the answer comes back saying neither. And of course, we all know that it's got to be one or the other. So you don't always often get a lot of sense coming through in the conveyancing process. So certainly, land registry, you can find from the title document when the building was purchased, potentially how much they bought the building, who the current owner is, look on company's house, find out the tax status of the business involved. These are all going to be key factors, but there are also many others. You do need to check the history going all the way back to 1996, which when the tax rewrite project went through and the Capital Allowance Act was rewritten in 2001, seemed like a very reasonable period of time. But of course, time has moved on, but there's still a requirement to check back to the mid-90s to see what any sort of previous owners have done as well. So those things you mentioned are all very sensible things to look at, and they'll give you a very good indication of what should or shouldn't be possible, but it won't give you a definitive answer.
Thanks, Andrew. But one more question here, and it's something, Andrew, I actually get asked quite a lot when I'm out and about with my clients and accountants as well. It's what happens if there's a change of use from residential to commercial, like service accommodation to a furnished holiday let? And I know it's something a lot of accountants and clients have been looking at recently with the change in tax legislation. That's from Gavin, so thanks for that, Gavin.
Yeah. On one side of the street, it's good news, and the other side of the street, it's not such good news. If you're going from non-qualifying to qualifying, so let's say you've got a buy-to-let house on the coast in Cornwall, and you're turning it into a furnished holiday let. At that point, when it's a furnished holiday let, you can tap into the value in the fixtures. You can claim as a percentage of the acquisition cost, even if that was many years beforehand, and also obviously the furniture and everything else that goes in there as well. However, you've got to be careful. If you travel in the other direction, you'll need to reverse out the value of the fixtures that are in place at that time. So it would probably be worthwhile letting the FHL or whatever change of use it might be, say to some sort of office or something along these lines, run for a while to check it is actually economically viable before then taking the step of quantifying what can and can't be claimed. There are things that potentially can be done to change the ownership of the building to close off the history before a conversion back to non-qualifying, but it's a bit more involved going down that route.
Thanks, Andrew. Just while we're on the topic of furnished holiday lets, question from Angus. Clients acquired furnished holiday let 4 years ago. Is it possible to still go back and make a claim for the previous 4 years?
It should be, yes. We would have to check the history. The reason why I say that is often furnished holiday lets have a nice clean history in that before the current furnished holiday letting use, they may have been someone's residence or a buy-to-let, which are effectively non-qualifying activities. However, if there's a furnished holiday let before, then we're back to potentially having to contend with the new legislation. So there's certainly no reason why they can't look back at it, unless, of course, the mandatory pooling and fixed value requirement put that 2-year time limit on there. So the first thing we'd do, I mean, if you want to give us a shout after this, Angus, and just all we need really is the address of the building. We can go to company's house, we go to land registry or the Register of Scotland, and we can get the full ownership history in Scotland, going back often to the 19th century, which is a bit more than we need, but when you request it, you get the whole lot. And we can see, what sort of use there's been in the past and what sort of entities have owned it. So the short answer is yes, should be fine, but as of all these things, we need to dot the I's and cross the T's.
Thanks, Andrew.
I just want to make one more point here, something to watch out for if you're representing a client who's selling a building. Like I said, the perfect worst hand. We've only had this happen a couple of times, and our clients have done very well out of every time it happens. But if you're selling a building, the worst thing you can do is provide evidence of all the capital allowances that you pulled on fixtures, potentially say a nice report from Deloitte showing that £1.3 million has been pulled on a care home that a client of ours was buying, and then proceed to not fix a transfer value by a Section 198 election. The reason why this is bad news for you as the vendor is that either party, so the purchaser in this instance, can make a representation to the tribunal to fix a determination, i.e. the value that goes on the election, in lieu of the election being agreed. Now that's generally very good news for the purchaser and very bad news for the vendor, because the tribunal's view is that you've got a purchaser that's made new qualifying expenditure on these items, and generally you've got a vendor who's just sold them at a profit. And therefore, as you can imagine, the value that comes out the determination tends to be somewhere near that doomsday market value disposal we saw from non-compliance with the new legislation. So if you're selling a building, Section 198s are a must. So a couple of questions you can just maybe run through. If a client of yours phones you up and says, oh, I'm looking at buying this building, looking at selling the building, is the legislation in effect? Check the tax status of the vendor. Often, a copy of the draft contract will tell you who they are, or look on land registry and so on, and a bit of a search around on company's house. Have allowances been claimed? Do we already know what the position is? Some buildings, especially where you've got larger tax-savvy vendors or clients who are advised by firms like ourselves, would have already claimed all the available relief and relieved it as well. So it's going to be an uphill battle to try and negotiate getting anything from them, because everything they transfer is going to have a cash cost to them. And the heads of terms may already have indicated that elections will be signed at £2 or whatever it might be. So a quick review of what paperwork's on the table is a must, because your clients may have already signed up to a certain arrangement. So has an effective transfer value been agreed? Things like auctions, for example, you agree to the auction terms before you bid. There could be all sorts of capital allowance related nasties in there already. Will the other side cooperate? I suppose a better way of phrasing this is who's in the driving seat. And that will change from area of the country to area of the country, whether it's a buyer's market, seller's market, who's motivated and so on. If you're calling the shots, you can generally push through more beneficial capital allowance terms. And of course, if you don't want to rock the boat on the deal. You don't want the tax dog wagging, so the tax tail wagging the commercial dog, if I can get my saying right. And the last one's just a bit of sense checking to save wasting your time, our time, the client's time. If the vendor is a commercial entity, then the majority of any claim is going to be in reference to what they spent to buy the building, not what your client is buying the building for. So if they've owned the building in the family through connected party transactions and inheritance going back to 1912 and got it for 4 and 6 and old money, it's probably not going to be worthwhile digging too far into the history and rocking the boat on the transaction. So a simple question: how long have they owned the building? What did you pay for it? So we've zoomed through the new legislation. Of course, it's a huge subject, and there's now no longer a one-size-fits-all approach to these sorts of capital allowance claims. Everything's bespoke because there's a whole myriad of variables at play. However, one thing that has certainly arisen since 2012 is that if you don't advise in this area, people can be set to make quantifiable financial losses that cannot be clawed back, cannot be fixed. And in those instances, of course, some clients in this ever litigious world will be looking for who it was that didn't advise them, who owed the duty of care, and whose insurance is going to pay me back my losses. So it's worth looking at whose duty of care is it. In essence, whose foot is it that's about to take the fall on the banana? Well, the case law in this area, the good news for everybody, in my view, having looked at it, puts the duty of care quite squarely on the conveyancer's desk. A couple of cases here, you may or may not be aware of them. You've probably all heard of the Major one. It was quite a well-covered case a few years back. But Clark versus Ilspruce Bennett. Ilspruce Bennett, firm of solicitors. Mr. Clark was selling his business. Ilspruce Bennett doing all the legals and so on and advising him on that. they missed out some pretty horrific tax indemnities in the actual documentation, which cost Mr. Clark quite a bit. He sued them successfully for not having advised them on these particular tax matters, even though their care letter clearly stated that they do not give any tax advice. And he was successful mainly because it was held by the judge that if a solicitor puts themselves, or any professional puts themselves out there as advising on a transaction, they should understand every facet of that actual process, and they can't simply just waive liability. For example, we can't put forward a contract to one of your clients saying we're doing this capital allowance work, but we don't take any liability for capital allowance claims. You know, it wouldn't stand up very long. And therefore, if tax can be seen to be part of the transaction, in this case it was on the sale of business, therefore the solicitors have a duty of care to advise upon it. Now, commercial conveyance, in this commercial property standard inquiries, which are used in the vast majority of transactions, they have their own section for capital allowances. So I think it's a very difficult argument to say that capital allowances are not part of a commercial conveyance. Possibly furnished holiday lets, residential buildings might be a different kettle of fish. But for commercial buildings, I would see the duty of care as sitting squarely on our cousins in the legal profession's desk. However, they are not stupid when it comes to matters of liability, as I'm sure you're all aware. In fact, in many ways, they're stock and trade. And what they tend to do is they tend to turn around to their clients and say, you need to speak to your accountant about this. It's a tax matter. And they will phone you up and they will say, I've got these this capital allowance election, or these terms, are these fine? And of course, the danger you have, if you give any sort of input at that point, the solicitor has just moved the duty of care off their desk and dropped it on yours. So be careful of this shifting. And sometimes it's done very consciously. I have been in meetings with firms of solicitors where at a table of 10, I've been run through, you know, the risks to their clients and the benefits to their clients. All the questions have been about how do we protect our liability and how do we reduce this. Mayhew versus Harbin Barker, some of you may be aware, Mr. Mayhew successfully sued his accountants, Harbin Barker, for not having brought forward the right tax avoidance scheme for him. Yes, you heard me right there. To be fair, it was Montpellier they put forward. So any of you haven't experienced, from what I saw, they were often the wrong firm to be to be brought forward. It was later appealed successfully by Harbin Barker on the basis that they don't have a duty of care to understand the ins and outs of all tax avoidance schemes out there. However, the initial ruling was reaffirmed by the judge, saying that accountants do have a duty of care to know when a transaction or a matter goes beyond their expertise and to make provision for advice in this area. So what does this all mean? Well, I think it boils down, it was summed up quite nicely by a quote from a well-known fictional character: do or do not, there is no try. I won't do the voice, but 10 extra points to whoever knows where that's from. It's actually Yoda from The Empire Strikes Back. Bit of a silly quote to use, but what I mean by this is you've got two options really, and this is the same in any area of tax. You either get up to speed to a level where you can put forward 100% complete and accurate advice, bring aboard the relevant specialists, you know, the surveyors and so forth, and provide a complete service in this area, or you don't do any of that and you move the headache off your desk and you refer it to us here at LS Tax. And there isn't really any middle ground. You know, the middle ground is where you get the problems. So, a couple of quick points on referring on. There's no negative reflection to you on in general practice. Tax regime in the UK is massive and growing at a rate of knots. No one can be a master of all of it. Even the likes of the Big Four have difficulty covering all the bases and then effectively communicating internally so that people know what they can and can't do. Clients don't tend to be unhappy if you reduce their tax. We got a lot of firms saying, well, what my clients say, you could have told me about this 5 years ago when I bought the building. Well, yes, potentially you could have done. However, it's much better to tell them about it now than to purposefully not tell them about it. And also, it doesn't tend. It's not a very difficult thing to position in a positive light. You know, just simply saying changes in legislation have put this much more on people's radar. We've seen the changes in 2012 and 14, and you need to look at this now or potentially lose all relief. So, It's not normally a difficult thing to put forward, but it is an unspoken concern in people's mind. I suppose the embarrassment factor. That's something we can obviously work together to put forward in the right way. And the final point really is that general practice is exactly what it says on the tin. If you were a specialist in everything, you would be back to being in general practice. It would be an oxymoron, wouldn't it? What we do, highly specialised, requires both surveying skills, valuation skills, and tax knowledge. Half of my team are RICS QSs. Okay, very rare general practice firm that has those sorts of members of the team on the payroll. So very similar to medicine. You wouldn't expect your local GP to also be a brain surgeon. I'm not comparing what we do to brain surgery, Chris. More like rocket science, but I think everybody gets the point. So a couple of quick seconds about ourselves. We're not alone in this sector, unfortunately. It'd be nice if we were. We have a wide variance of quality of competitor out there, as I'm sure some of you have come across. At one end of the spectrum, we have firms that go around making very conservative claims for fear of ever having to speak to HMRC. And unfortunately, we do, like in most areas of tax, have some cowboy operations who have very aggressive sales techniques, go around making very large, unfounded, inflated claims with no knowledge of the legislation that underpins it, on the basis that when the proverbial hits the fan, they are not going to be around anymore to answer those questions. S-Tax, we sit in the middle. Client of ours called us the Goldilocks of capital allowance advice. You should really have trademarked that. I owe them a fortune by now. We're not too hot, we're not too cold. We are here to maximize the benefit to our clients, but we're not going to put forward anything we're not 100% having a chat, happy having a chat with HMRC about. So why use us? Well, we're a professional firm, over 6 years, well, 7 years in the sector now, actually. We only charge as a percentage of what we deliver. There's no fixed fees, no upfront fees. Everything's guaranteed on success, and it includes any HMRC inquiry cover. So if we get stuck into a scenario, for whatever reason, no claim can be made or a very small claim can be made, well, our fees are only in reference to what we actually do achieve, and therefore your clients can, as long as they're paying tax, can only ever be cash flow positive working with us. We take it on the chin sometimes. We run a loss leading piece of work, but we get a lot more instructions as a firm because of that. Track records, no claims rejected, only 2 small haircuts to date. Obviously working our PFP for the last couple of years. So we do the work for our firms in general practice as much as possible. We don't pile everything back onto you guys because we appreciate that you are running your own business and you've got your own stuff there to do. We're the ones being paid to do this. So we're the ones who should be doing it, to be blunt.
I mean, that's certainly something that we see at PFP with our member firms. And quite a large number now do work with Andrew's team at S-Tax, is just the ease of the whole process and how little work's actually involved for you guys. And Andrew and his team take on everything from start to finish with no stone unturned. So that's been a real positive for us at PFP and all our member firms.
Yeah, a lot of information's out there in public record. I mean, we could be lazy, obviously, and write to our partners and ask for it all from you guys. You could go digging through the files for the last 20 years, or we could go digging through Companies House, Land Registry, the planning portal. You know, we can get the information, a lot of it, from public records, and therefore it reduces the time burden on yourselves. So, if you are interested in what we talked about today, the kind of next steps we can look at individual cases. All we need is the address of a building at a bare bones minimum, and we can find out all the information we need to come back and give you a pretty good projection of what can or can't be achieved. In some instances, we've gone into firms' offices and sat there and reviewed the client bank to help identify clients who are at risk of the new legislation, clients that could benefit from looking at this, and of course, the part of the client bank that it's not relevant to as well. We can help guide you and your clients and their conveyancers through the sale and purchase process to ensure compliance and to make certain they're not going to miss out on any sort of benefit by pro forma documents. As you know, the guys at PFP are very proactive with their marketing material as well. We've got newsletter content, we've got little booklets and flyers and so on.
Email shots. Yeah. There's a huge raft of marketing material we can do on your behalf, bespokely put together as well. So it's very much about yourselves and what you're promoting to your clients. And that's been very popular with a lot of firms as well as the client review meetings as well. I think that's a real positive for a lot of firms that we offer with Andrew and his team there.
We're a national firm. We're headquartered on the south coast in Brighton. We've got another office in Farringdon, London, and an office up in Liverpool. My survey teams are dotted up and down the length and breadth of the country. So wherever you are, I mean, I myself spend a hell of a lot of time traveling around seeing people. we're going to be somewhere nearby to you and be able to come out and see yourself, see the clients face to face as well, if that's what you want.
We've got a couple of minutes left, guys, and there's just quite a lot of questions we've had throughout the webinar. I'll try to answer some as we go, and we'll get back to everybody on email with the question we had. There's a couple of quick ones to go through. One from Kuan, Airbnb, can it qualify as a furnished holiday, Andrew?
Airbnb or not is to some degree irrelevant. It's the criteria for the furnished holiday letting, which is the 105 days actually let in the year, periods of not more than 30 days, available for letting for 210 days of the year. So you can't have it on a 6-month AST and then short-term lettings in the summer, because you fail on that criteria as well. It must be furnished. Doesn't have to be holidays though. The largest number of furnished holiday lets we've done has actually been in East Croydon. I don't know who's going on holiday in East Croydon. Don't get me wrong, I'm not knocking East Croydon. There's a lot going on there at the moment, but it tends to be kind of not so senior international bank executives and key workers and so on. So Airbnbs, yes, as long as they still hit the FHL criteria.
Thanks. Question that's come through from Vardy. Would a charity still need to meet the pooling requirement if they were selling on through a limited company?
If they have fully exempt status and they've owned the building since before the changes, then no, they wouldn't, and therefore it's quite good news for the purchaser. But you've got to be careful. Not all charities are fully exempt. Some of them may have partially sublet buildings, which again would be, in many instances, a taxed activity, which means mandatory pooling might have a bearing on a proportion of the floor space or even all of it.
Okay. And a question that we get asked every time we speak about capital allowances: will claiming capital allowances, and this has come through from Rob, so thanks Rob, will claiming capital allowances affect the capital gains tax computation?
Not capital gains tax computation. You do not reduce your base cost by the amount claimed on fixtures. So if you bought a building for £1 million and pulled 200,000, your base cost is still £1 million. So on the upside, it does not increase your tax. However, there is a restriction on allowable losses on the negative side. So if you sell at a loss, then your allowable loss will be reduced by the amount claimed on fixtures. So to give you an example, remember back to Mr. Cinderella, bought for £1 million, claimed 250. Let's imagine that's all been written down and gone. If he then sells the building at £500,000, he doesn't have a £500,000 allowable loss. He only has 250. That's the £500,000 minus £250,000. He's left with £250,000. So in the current market, of course, most parts of the country, values are going up. So it's not normally a concern. But of course, that's not always the case.
Quick question, one more question, and I know the answer to this is a fairly simple one. It's from Dina Jones. What about Scotland? Are they the same rules?
Yes.
Nice and simple. Thanks for that, Dina. Guys, we've run out of time. Hours up for today's webinar. Thank you all very much for attending. I know you're about to head into a very busy period for most of you guys. Apologies for the slight poor sound quality with the wind howling around behind us. I hope you've enjoyed today's webinar. We'll be sending out copies of the slides, and also recordings are available as well if anybody in your team or anybody wants them. So thanks very much. Thank you very much, Andrew, for attending today.
Thank you.
And look forward to speaking to you guys soon.